Hi everyone, and welcome to Module 2, Investments. In this module, we are going to talk about how a company will account for a case where they make an investment in some second company. And this investment can be made either in the form of a debt investment or in the form of an equity investment. So company A can lend money to company B, so they can lend the money, or company A can buy partial ownership in company B, so take an equity stake, an equity investment. So we have debt investments, equity investments. All right, so let's hop over to the computer and let's walk through a comprehensive example so that we can understand what's going on in this module. I'll see you in just a minute. All right, so as I mentioned, when one company invests in a second company, the investment could be in the form of debt or it could be in the form of equity. So if we're talking about debt investments, we're talking usually a case of one company purchasing the bonds that were issued by a second company. And this investment, in debt, for accounting purposes, can be classified into one of three categories. Okay, and these three categories are, let's put some boxes in here. All right, so we could classify something as held to maturity, HTM investments. All right, and let's resize this so it looks a little nicer for us. All right. Okay, so we can have held to maturity investments. That's one option for accounting purposes. Another option is what we would call a trading security. So trading securities, so TS. And then the last one would be available for sale securities, AFS. Okay. All right, so three categories here when we're talking about debt. And then we can add, just a line showing that these are the three categories. Okay, so we have three different types of debt investments: held to maturity, trading securities, available for sale securities. What's important to note here, in the real world, the investment is exactly the same regardless of the accounting category we place on the investment. Okay. So, for accounting purposes, to record these transactions in our financial statements, we are going to put the debt investment into one of these three categories: held to maturity investments, trading securities, available for sale securities. But in the real world, it's the same exact investment. If a company buys a bond in another company, just because we place that investment into the trading security category for accounting purposes doesn't mean that anything different happened in the real world in terms of that investment being made. Okay, so we're doing these categories, or we're making these categories for the purpose of accounting only. All right, so why would we split these up into three categories? Well, it comes down to now, let's step back. Accounting is the language of business, and the purpose of accounting and financial reporting is to provide useful information to people outside of a company so that those people can make decisions. For example, investors can use the information to decide whether or not to invest in the stock or to continue to invest in the stock or to sell the stock. So we're trying to provide useful information. Well, what counts as useful information really depends on one key question, right? So the key question is, let's put another text box in here. The key question why is the company buying the bonds? Or in other words, why are they making the investment? What is the purpose? What is the purpose? Okay. All right. And this question is what leads us to having multiple categories here for accounting purposes. And let me shrink this a bit. Okay. So this is the key question we have to ask ourselves. So we think about held to maturity securities. We're going to put into this accounting category cases where a company makes an investment with the intention of holding that investment until the investment matures. Okay. Trading securities, on the other hand, will be investments that are made for a short-term purpose only. So the investor is trying to make a profit from changes in the market price of the investment. Okay, so companies can have different objectives. They could have a different purpose for making a debt investment. And one of those purposes would be to just hold the investment until it matures and collect the coupon payments, collect the returns over time. Or the company might be interested in flipping it, buying the investment, holding it short term, hoping the market price goes up, and then selling it right away. And then we have this other category, which we call available for sale. And this would be somewhere in between held to maturity and trading. So they're not necessarily planning on holding the investment until it matures, but if the price in the market turned favorable, they might be willing to sell. So they're not actively trying to sell it, but they would sell if the price was right. Okay. So if the investor has all these different intentions, what the investor in this company, right? So we have, it can get a little confusing. So we have, let's put another shape in here. So we have, company A, they are investing in company B. Okay, we have two companies here. Let's clean this up a bit. And let's put in another shape here. Okay. And then we'll just say investment. Okay. All right. So we have company A in making an investment in company B. And company A might plan on holding the investment until it matures, or it might plan on buying this investment short term and flipping it and selling it in the open market, hoping that the market price changes in a favorable way in the short term. And then available for sale would be somewhere in between those two categories. They would sell if the market price became good. All right, so suppose you are an investor in company A, right, so you are company A investor. Okay. What do you want to know? If, let's say you are the investor, you're the investor in company A, and company A has invested in company B. Well, if you are the investor in company A, what do you want to know about the investment in company B if company A is planning on holding this investment until maturity? Chances are you're going to want to know something different if that is the intention versus what you would want to know if the company is planning on selling in the short term, if they're trying to capitalize on changes in the market price. Okay, so what you want to know depends on what you want to know as a company A investor is different based on the intentions of company A in making the investment in company B. Because if company A plans to hold the investment until it matures, you don't really care if the market price fluctuates. The market price is never going to matter for you. But if company A is trying to flip this investment, make a short-term profit on short-term market fluctuations, then you do care about changes in the market price. So that is why we have different accounting treatment depending on the purpose of the investment. It's because we're trying to provide useful information to people outside of the company, and what is deemed useful information depends on the purpose of the investment. Okay, so that's what we're getting at here. Okay, so this is our first video discussing Module 2. So this is part 1 of a series of videos explaining accounting for investments. So please stay tuned. In video number 2, we'll talk about how we'll actually go through an example of how we account for different debt investments. All right, well, thank you for watching. I hope this video has been helpful in helping you to begin to understand accounting for investments, or debt investments specifically. All right, well, thank you for watching. Take care, and I'll see you in the next video.